A bullish 180 reversal is a two-bar combination with the first bar closing bearish at or near its low, then the next bar reverses and advances above the high of the bearish bar. A bearish 180 reversal is a two-bar combination with the first bar closing bullish at or near its high, then the next bar reverses and declines below the low of the bullish bar. 180 reversal bars are powerful reversal patterns because of how they affect the expectations of traders who committed to a position in the first bar of the pattern. Let's go over some examples of 180 reversal patterns. Bullish bars that close at or near their high, which are followed by a reversal on the next bar that declines below the low of the bullish bar, are bearish 180 reversals. Bearish red bars that close at or near their low, which are followed by a reversal on the next bar that advances above the high of the bearish bar, are bullish 180 reversals. Compare pattern D and pattern G. Determine which pattern is more potent. You may look at these patterns and say, G is more potent because the green bar closed much higher than the red bar in comparison to the green and red bar in pattern D. If that's what you said, it's true, but that's not the point I want to make. The open of the green bar on pattern G gapped up. The gap up immediately trapped anyone who sold short the prior red bar and immediately caused them significant losses. The open of the green bar in pattern D is relatively even with the prior red bar's close. The open of the green bar in pattern D did not immediately trap the traders who entered a short position on the prior red bar. This shows us as prices begin advancing higher on pattern D, some of the traders who entered a short position in the prior red bar had an opportunity to exit their position with little or no loss. Pattern G did not afford any traders this opportunity to exit their position with a small loss. The gap up trapped everyone who entered a short position in the prior red bar immediately. Pattern G closed much higher than the prior red bar because traders scrambled like crazy to limit their losses and exit their position. Pattern G is more potent than pattern D because the gap up immediately trapped the traders who entered a short position on the prior red bar. Pattern E is a two-bar reversal that is potent, but the red bar did not take out the low of the green bar, so it is not a bearish 180 reversal. When a potent reversal like the red bar at E does not have follow-through, meaning it does not cause prices to continue lower, it is signaling the reverse message and confirming the strength of the buyers. A bullish range expansion is a bar that advanced from its opening price and is larger from high to low than the prior bar. A bearish range expansion is a bar that declined from its opening price and is larger from high to low than the prior bar. Let's go over some examples of bullish and bearish range expansions. There are more examples on this chart than we are pointing out. Range expansion bars are larger in range in comparison to the prior bar. Expanding in range shows us there is an increase in activity on these bars. Range expansions are common, and there are several on this chart. Focus on the ones that are obvious. If the current bar expands in range a small amount over the prior bar, there has not been an explosion in activity. The bars where activity explodes is where we look for opportunity. A range expansion bottoming tail is a bottoming tail that has a range from high to low that is greater than the prior bar. A range expansion topping tail is a topping tail that has a range from high to low that is greater than the prior bar. Let's look at some examples of range expansion bottoming tail and topping tail bars. Bars that have a topping tail or bottoming tail that expanded in range in comparison to the prior bar are range expansion bottoming tail or topping tail bars. The bar at C is a topping tail, but this bar is not a range expansion topping tail. This bar did not expand in range in comparison to the prior bar, which means there was not an increase in traders who were caught in this topping tail like they were in all of the other examples. The range expansion bottoming tail at B shows us there was an increase in traders committing their money to a short position on that bar, which is what created the tail. The short sellers quickly found themselves experiencing losses when that bar closed a range expansion bottoming tail. Range expansion bottoming tail and topping tail bars are potent, and they may provide us with an entry to a position if they happen within an infinity pattern. An inside bar has a body that is within the body of the prior bar. It does not matter if the inside bar is red or green. It also does not matter if the high and low of the inside bar are within the body of the prior bar. Let's look at some examples. There are more inside bars in this chart than we have pointed out. These bars are very common. They show us there has been a stall in momentum, or that traders have become calm. These bars can at times provide us with an entry for a position if they happen in the correct area within an infinity pattern. A breakout is when prices create resistance for a minimum of 2 bars, then advance above that area. Increased buying that overwhelms selling is what causes prices to move above resistance. On pattern A, prices advance until they find resistance and consolidate for 2 bars. Mark off the highest point of the 2 bars as resistance. When prices advance above the resistance, that is when a breakout has occurred. Pattern B found an area of resistance that prices cannot move above for 3 bars. The tails of these bars are not even. They don't have to be. Prices are contained within an overall area. Resistance is not an exact price point, it's a general area. When prices are contained within an area, recognize the highest tail in the consolidation as the breakout point. Mark off the highest tail as resistance. When prices advance above resistance, a breakout has occurred. Prices advance on pattern C, then found resistance and declined. The turning point at the high is an area of resistance. Mark off the highest tail at the turning point as resistance. When prices advance above resistance, a breakout has occurred. On pattern D, prices found resistance and formed a multiple bar consolidation. Mark off the highest tail within the consolidation as resistance. When prices advance above resistance, a breakout has occurred. Pattern E formed 2 bars that are contained within a range. The highs of these bars are not equal. That's okay. Prices are contained within a range. Mark off the highest tail in the consolidation as resistance. When prices advance above resistance, a breakout has occurred. Breakouts form in many different ways, but the reason prices broke out is always the same. Prices break out because buying overwhelms selling. Let's go over some of the different ways breakouts form. There is an area of resistance prices cannot move above on pattern A. Mark off the highest tail as resistance. When prices advance above resistance at B, that is when a breakout has occurred. Prices advance and find resistance on pattern C, where they consolidate for several bars. Mark off the highest tail in the consolidation as resistance. When prices advance above resistance at D is when prices broke out. Prices found resistance at E where they consolidate for 2 bars. Mark off the highest tail as resistance. When prices advance above resistance at F, that is when a breakout has occurred. Prices found resistance at G for 2 bars. Mark off the highest tail as resistance. When prices advance above resistance at H is when prices broke out. Prices find resistance for 3 bars at I. Mark off the highest tail as resistance. When prices advance above resistance at J is when prices broke out. The traders who entered a long position on pattern A have an expectation to make a profit from higher prices. On pattern B, when this bar closes at its low, those traders' expectations have been reversed as they quickly found themselves holding a losing position. Failed expectations are powerful because traders are caught on the wrong side of a trade. When traders get caught on the wrong side of a trade, there will be increased buying or selling as they exit their losing position. Increased selling that overwhelms buying is the only thing that can cause prices to decline. A breakout failure is when prices decline back through the breakout point. When prices advance above an area of resistance, it is because there was an increase in buying that overwhelms selling. Those buyers have expectations that they will make a profit from higher prices. When prices immediately decline back through the point they broke out from, it changes the expectations of traders who bought the breakout because they're now holding a losing position. This will likely lead to an increase in selling pressure as the losing traders close their position.